About a year ago, I started noticing a parallel between the housing market and the labor market. Unemployment in the country is very low. Everyone has a job. The conventional wisdom for almost 3 years now has been that the job market must weaken, unemployment must be rising. But for 3 years, unemployment has stayed very low. Normally, when unemployment is this low, we're confident that we'll find a new job and we're much more likely to quit a current gig that isn't right for us. But an interesting thing has happened in the post pandemic era. Even though layoff rates are really low, the rate at which companies are hiring is also very low. As a result, we aren't quitting our jobs. Nobody wants to upset their current situation. Companies are reluctant to hire more. Employees are afraid to quit. No one wants to move. Compare that to the housing market. Homeowners have a good thing in their cheap mortgages and high equity. Buyers are reluctant to buy. No one wants to move. Over the last decade, Americans were migrating quickly from the high-cost coastal states to the Sun Belt for cheaper homes. In the last 2 years, that migration has slowed way down and even reversed in some cases. So since moving now from your existing mortgage in New York, for example, to a cheaper house in Texas doesn't actually save you money, nobody wants to move. Housing, like jobs, is in what I've been calling the great stay. That has supply and demand implications and also price implications. Wages are up, and so are home prices, which is actually somewhat surprising. So that's what we're going to cover this week. At Altos Research, every week, of course, we track every home for sale in the country, all the pricing, all the supply and demand, all the sales, all the changes in that data, so that you can understand the changes in the U.S. housing market immediately as they happen. I'm Mike Simonsen. I'm the founder of Altos Research. So how does the great stay look right now? Here's this week's data. Overall, the inventory of unsold single-family homes on the market declined this week to 732,000 homes. That's down 0.25% from last week. And there are now 34% more homes on the market than a year ago. Last year, inventory was rising by almost 2% per week in the middle of October as home buyer demand deteriorated. This week, it fell by 0.25%. So the inventory trends are very different compared to a year ago. There are 34% more homes on the market now, but just a few weeks ago, that was a 40% difference. So that's compressing now each week. Some of this week inventory decline was helped by Western Florida, which had a lot of withdrawn listings and very few new listings due to the 2 hurricanes. Tampa has several percent fewer homes for sale now than a couple of weeks ago. Of the big cities which experienced increased inventory for the year, Phoenix has not yet peaked. Denver has not yet peaked. Denver has more unsold inventory now than at any time in the last decade. Southern California inventory probably peaked for the year. LA has more homes on the market than a year ago, but fewer than other recent years. Dallas inventory ticked down for this week, but that's just 1 week, and there is a lot of homes for sale in Dallas. So even though Tampa has fewer homes for sale this week, Orlando, which escaped much impact from the storms, has more. So this is a pattern that I've been talking about recently. This is the great stay. We are staying in our jobs longer, we're staying in our hometowns longer, and in our houses longer. You can see the great stay in the inventory data. So for metros that you think of as outbound migration markets, that migration has slowed. So those outbounders are selling less. So inventory is tighter in LA, Chicago, New York, et cetera. For the assumptive inbound migration markets, that's where inventory continues to build. Denver, Texas, Florida. So I expect the great stay to mitigate some next year if we're lucky and interest rates ease and provide a stimulus for the economy. If that happens, then these migration patterns would pick back up slightly, so the regional imbalance in inventory would moderate. Next year, though, we'll see if that happens. For now, you can see the great stay pattern in the inventory trends. The new listings ticked up to 63,000 this week, plus 10,000 more immediate sales. That's in total about 8% more sellers than a year ago. So 8% more sellers is about what we've been averaging each week all year. Slightly more sellers than the very dry 2023. 2023 was probably the peak great stay. During this year, as rates stayed higher for longer, sales did not increase, and that meant inventory of unsold homes was increasing. This week, though, with more sales and more withdrawals, inventory fell. There's a lot of turmoil in the Florida markets, especially Tampa and like Sarasota, for example. Those are big enough markets to skew the national totals. So that's part of this week's trend for sure. As has been the case all year for me, I'm watching the new listings count for pent-up signs that pent-up seller supply may start leaking or surging onto the market. So in this view here, the dark line would rise to the old normal levels. In October, it would not be uncommon for 75 or 80,000 sellers to list their homes in the middle of October. Once the great stay conditions ease, one place we'd see that is in rising rates of new listings each week, but we just don't see it yet. After the new year, if we're lucky and mortgage rates have eased back down, we could be setting up for stronger selling season in the spring. Until then, it doesn't feel like we'll have a new trend in the seller supply. It will remain mostly restricted this fall, but we're going to keep watching for any changes in that trend. So we're now at the third week in a row with more sales than either of the last 2 years. So even though sales are not strong, the conditions are better than they were in the fourth quarter of 22 or 23. In fact, the 61,000 new contracts pending this week for single-family home purchases was 16% more than the same week a year ago. At that time, sales were really tanking with the mortgage rate spike. The last few weeks have been averaging 9% more sales than last year. There are another 11,000 condo sales this week, new contracts for condos. So condo sales are weaker than single-family homes right now. Condo sales are basically flat compared to last year, so the growth in the market is coming in the single-family home purchases. Mortgage rates are back up recently, so I expect this pace to dip a bit over the next few readings. But you can see the chart here. The dark line for this year has very easy comparisons to the last 2 years. So if mortgage rates keep climbing towards 7%, I'd expect you'd see these gains evaporate. Buyers walk away, inventory climb, and that weekly sales count to drop closer to 55,000 per week from 61,000 where it is now. So these home sales gains are average across the country, but the recovery is not the same in individual markets. It shouldn't be surprising that Florida is averaging fewer sales than the last 2 years, given the hurricane impacts in much of the state. Texas is averaging about 10% more sales now than the last 2 years. States like California, Colorado, Ohio have grown compared to last year, but are still averaging fewer home sales than each week in October of 22. So the key takeaways when we look at the weekly newly pending home sales count is that nationally, we can see slightly better conditions than the last 2 years. This growth differs per local markets, though, and is very dependent on mortgage rates not jumping back up again. These are very fragile gains. The median price of all the homes that went into contract this week is $389,000. That's down 1.5% for the week after a surprising climb over the last month. It's been really notable how home prices climbed at the same time that sales responded to lower mortgage rates. Home prices have generally not declined, even as sales have been weak for 2 full years, but they moved up as soon as demand picked up, even a tiny bit. I think it's fascinating to watch and important to point out that even in those markets where inventory is building, for the most part, we have not observed home prices falling. Why is that? Well, in the Great Stay, the parallel is like the labor market again. Companies are not hiring new workers, so in some sense, demand for workers is way down. But the supply of workers is way down too, since we're not quitting our jobs either. As a result, income is growing for Americans. Supply and demand are working together to create a surprisingly supportive environment for salaries and for home prices. Home prices also have a condition called downside stickiness, which is visible in all markets, but may be especially strong now during the Great Stay. So home sellers have a current price in mind, and they don't really want to sell for less. This is known as loss aversion. I'd rather not sell my home than to take a lower price. And so we see this now with homes being withdrawn from the market rather than discounted to spur demand. And because homeowners have such cheap financing, they actually have the upper hand right now. In other words, it's very cheap not to sell my house. This is the Great Stay. The pricing psychology has its limits. At some point, if there's a tipping point, then loss aversion actually makes me feel more urgency to sell. This happened in the 2008 bubble burst. Like if I see prices in a deflationary spiral, I am more incentivized to dump my property now before it gets worse. That action, of course, makes it worse. So we have not seen that spiral anywhere in the country. There are lots of folks who watch our video each week who think it's coming or even hope it's coming, but there's no evidence of broadly declining home prices anywhere in the data yet. So for example, Denver has more homes for sale now than any time in the last decade, but home prices are flat from last year. So in fact, the takeaway for home prices is that they were sensitive to the upside as soon as mortgage rates ease down closer to 6%. So in this chart, you can see the dark line for 2024 and how it climbed recently compared to the weak pricing of the fourth quarters of the last 2 years. The percent of homes on the market with price reductions grew by just 10 basis points this week. Currently, just over 40% of the homes on the market have taken a price cut from their original list price. That's slightly more than last year this time and hasn't started coming down for the fall. But the fact that the price curve has been flat for over a month is telling, where buyers and sellers are settled into this Great Stay equilibrium. It tells us that there's no deflationary spiral visible, even though home buyer demand is still pretty low. So this is a time of year when it would be totally normal for price reductions to be accelerating. It's late in the season. If your home has not seen offers, you might opt to cut the asking price to stimulate demand. So the fact that price reductions are not accelerating tells us that there are some home buyers at these prices. It illustrates that sellers have no urgency to sell at a discount. They'd rather stay. We measured withdrawal rates pretty high nationally. And if you don't have offers for your home at this price, you have two options. You can cut the price or withdraw the listings. In other words, stay. So far, many homeowners are choosing to stay. In this chart, we see how the very weak markets of 2022 and 23 were deteriorating in the fourth quarter. Price cuts were accelerating in those years. This year is different. So if we're unlucky and mortgage rates spike here this autumn, I expect you'll see very quickly in this price reductions curve, the same way we saw it over the last 2 years. So those who can stay will, those who cannot stay will cut their prices. It's wild how quickly the sentiment can change in like a week. So we may be at a transition point to get to home sales growth. Suddenly though, we see a big spike in mortgage rates. So we know that buyers can put the brakes on very quickly. So potential buyers and sellers need to hear the data from you so they know how to act. If you need to advise people in the real estate market, you should join us at Altos Research. Go to altosresearch.com, book a free consult with our team. We'll help you know how to talk about the market with your clients and prospect today. We'll help you look at your local market. So there's a link in the description below to join us. Click that and let's get started.